Most traders only know how to make money when the markets go up. They buy the dip, they hold in hope, and they pray that the market ends up going up and they end up making money on the upside. But what happens when the market tanks? What happens when you can't find any long opportunities and you start a bigger downtrend? They just sit there forcing long trades or not taking any trades at all, and that adds up to loss after loss after loss, and they're not able to adapt to the markets fast enough. Today I'm going to show you exactly how you could actually play the downside. This is something that 95% of traders literally cannot do, and how to execute this well and even potentially make more money trading the downside in a bearish trend than the upside in a bullish market. And the beautiful thing about shorting and playing the downside in stocks is it's not anything complicated. It's actually just the exact inverse of my long strategy, and you could still make a ton of money in the markets as long as you look for the right setups and have patience. When you go long, you're looking for stocks that are breaking above resistance, making a big move and breaking out of their base. And when you're going short and looking to play the downside in stocks, you're looking for the exact same thing, just on the other side. You're looking for stocks to start breaking their key supports, lose key levels, and make big downside moves. But the key is always momentum. When you go long, you also buy into the key moving averages on every single pullback because you know that there's a good trend. Now, when the market starts to reverse and you have a downside trend, you could sell into the moving averages as the trend continues and continue to look for a continuation move within the market. These are the same patterns, the same setup, just really flipped upside down. And keep in mind, and have you ever heard of the saying, staircase up, elevator down? A lot of stocks can make their moves faster to the downside because of the fact that there's fear and there's a ton of panic that happens on the downside moves. I'm about to jump on the charts and show you exactly how to spot these setups, exactly how to enter these setups, and how to have the confidence to be able to make money on the downside so you can finally learn how to make profit in the markets when it's going down. And this is the beauty of the stock market. There's always opportunities, and you can always make money regardless of if the market is going up and if the market is going down. Let's get straight into it, and I hope you enjoy this video. All right, guys, so I'm going to show you exactly how to short stocks in the market, and I'm going to show you 3 different entry models that you could use and 3 different setups that you could use as well to get the best probabilities on your downside. Now, I'm going to start from my favorite, and then I'm going to go all the way to a good setup that can work really well. But we'll start with my favorite setup, and this is called just an inverse of the long setups that we're going to be looking for in the market. This is a breakdown. So with breakouts and big moves to the upside, we obviously know we're looking for stocks that are compressing, going sideways like this, and then they break out of their base and make a massive move to the upside. Now, what if we could just flip that around and look at the inverse? Well, here's an example of a stock that made a massive move to the downside on that exact kind of basis. And I was able to trade this one for a $10,000 trade just by being able to catch it right as it was breaking down out of this key support and shorting it. Now, the first thing we need to understand when we're shorting stocks is we have to start with the major index. We don't want to be shorting stocks too quick because whenever we're in a large uptrend, we usually always get a nice buyable dip that continues to go higher. So if you zoom out, you can see for the last few months, we've continued to go to the upside almost every single time we've dipped into the moving averages. But what changes now? Well, now you have a break under the moving averages, and this is why it's important to use these moving averages to tell you what the trend of the overall market is, because if we can use this as a rule and a basis for our guide for our trades, we can make so much more money in the markets because we're not guessing anymore, oh, is today a good day to short? Is today a good day to long? As long as we're above all the moving averages, you should be looking to long. But once you start getting below the moving averages and the moving averages begin to kind of curl the other way and also cross below each other, now you have a confirmed downtrend. So now actually every single pop is getting sold and you're getting lower highs and then you're making new lows. And that is actually a downtrend. That's what categorizes a downtrend. So once we notice we're in a downtrend, this is the best time to look to short the markets. So this is the setup that I saw on the ticker Costco. As always, you want to start on the bigger time frames. So I like to use the weekly and daily. And you also want to make sure that the stock you're trading is under the moving averages. So this one right here, for example, is under the weekly moving averages, and it's set up in a massive weekly base. And it was looking like it was ready to break down, right? This has been a weak stock for a while. It hasn't been able to make any new highs, and it's been downtrending for pretty much months. Ever since this high right here, it's been making lower highs, lower high, lower high, lower high. So what does that mean? Well, it means the pressure is building, right? It continues to build the pressure, and then eventually these kind of longs in this support cannot hold the stock up anymore, and then it starts to break below and the big flush under happens. So how do we actually trade this? Well, the first thing that's important is we have to mark out the base. Here's the base of the stock. It's setting up in a super tight kind of pennant. It's below the moving averages. And then we have to mark our key support level where we're going to use for our entry. So once we have that, all we have to do is patiently wait for the stock to break under that level. We don't have to take it before, we don't have to take it after. We want to take it right as the break is happening. So you can go down to the lower time frames. What I like to use is I like to use the 15-minute and the 5-minute. So we'll use the 5-minute for this example. And what we're looking to do is just wait until the stock starts to break below this key level and you start seeing some good volume coming in, right? Once you start seeing this breakdown right here, this is going to be your entry. So at my exact highlighted spot, this is going to be your entry, and then your stop loss is going to go to the high of the day. Now you're risking the high of the day, and then you're looking to target a big key level of support. So for this example, you could see the stock absolutely cratered and made a massive move to the downside. You got an absolutely incredible entry right here as the stock was making that move down, and you were able to buy it right here as the stock was breaking that key level. That was your entry. And then this is kind of how your short looks. So this is your entry, that's your stop. And then you end up being able to catch this one for a big continuation move. Now, how do we take profits? That is going to be a very important kind of factor to this analysis. You want to take profits into big key levels of support. So for example, if this is my entry right here, I'm going to use this as my first target because that's a big level of support. And then I'm going to use these lows right here, right? And you can see that's actually where we bounce all the way at this bottom here. And then you can hold the rest of the position as a potential kind of runner, right? So as long as you have profits, you can hold this into the next few days and look to see if there's going to be continuation to the downside on these stocks. So that's exactly how you're going to be able to trade a breakdown. And this is a great way to catch very quick moves in the market and very, very explosive moves down. And if you can catch puts on this, which I love to do, especially usually 1 to 2 week out options, I can catch an absolutely amazing return. So I made about 300% on this Costco trade just by being able to catch it as it was breaking down out of this key level. And then also this Tesla trade was a very similar one as well. You could see it broke that key level right here, this setup in a super tight base, but it got below the moving averages. And then right here, it broke below, made a massive move to the downside. So a lot of times you really only need 1 or 2, 3 days for these moves to play out, because of the fact that there's so much consolidation. And remember, consolidation always leads to really big moves. You can see we got a very, very quick move down on this stock Tesla right here. So what was the setup? It was a big base. We had a failed breakout from the highs. It broke under the 50 EMA, and you could see volume was coming in, and it failed to hold the previous low and the low of the base. So how do we trade this? Well, first of all, again, we have to get our level of support. From there, we go down to the lower time frames. You could use the 5 or 15 minute. The moment the stock breaks below our key level, we are going to put our entry right there, stop loss at the high, and then we're going to look to target a key level of support on the daily time frame. So that would be obviously this low right here. The gap fill is a pretty big level of support. And then the next one could maybe be somewhere down here. And as long as the stock doesn't get back above the high and reclaim, you can continue to swing it and continue to play this one to the downside, and it can continue to move lower because it's downtrending, right? And that's the most important part. You want to make sure you're trading stocks that are technically already in a downtrend. They have to be below the moving averages, because then every single pop is going to get sold. So even here, you can see we had a pop a few days after, but it got sold off very quickly because of the fact that this stock was downtrending. Now, after you start to kind of use this as your kind of framework for the big move down in the market, sometimes stocks are going to become a little bit extended after the breakdown, and there's not really going to be that many bases. So what can we look for? Well, we can look for continuation patterns. So this is a good example right here on the ticker Tesla. It's actually setting up in a bear flag, and all you need to do here is just look for the bear flag to break down, break this kind of level of support. So if we go on the hourly, we could see it a little bit better. If we break this trend line right here, that's when we can start looking for puts on this. So if it breaks this low, we can look for continuation to the downside. Now, another entry category that you can look for, which is one of my favorites, is called an RDR entry. So a stock needs to already be in a downtrend. This is, for example, a very, very good kind of example here on this stock right here. It broke down from this big base. It failed to break out higher. Now it's downtrending. It's below all the moving averages. And it already made such a big move down here. This is where it's too kind of late to short. But then it pops back into the moving averages, right? So just like when we buy stocks to the upside into the moving averages, we could sell them into the moving averages as well to the downside. So you can see this one popped back into the EMAs right here, and then it ended up selling off really well. So how do we actually trade this? Well, first of all, we're going to make sure we mark out the potential kind of bear flag that's forming on this, which is this. But we want to trade this on the rejection of the previous day's high. This is called an RDR. So meaning the stock breaks above the previous day's high. So if you mark that out and then it fails to hold it, that's going to be your short entry. So let's see how this actually looks on the lower time frames. So on the 15-minute time frame, you can see that's the previous day's high. We broke above the previous day's high right here. We failed to hold above, and we broke under, and we made a massive move to the downside. This is going to be our entry right when the stock starts to fail holding this high right here and then comes back into the range. That's going to be your stop loss at the high of the day, and you're going to target previous day's low, which would be right here, which was the exact target for this trade. And then again, the rest of the position should be kind of a position that you trail. You could swing if you have profits if you want, but the whole idea is to play that quick move to the downside. And then you can see on the daily, this one is clearly downtrending, and it's probably going to continue to go lower just based on the fact that it's in a very strong downtrend. Here's another good example that I kind of caught on this ticker as well, ARKK. This is when you have a stock that breaks down, and you might miss the first breakdown, like kind of like the Costco and Tesla trades that we went over, but you can also look for a retest. So those are going to be our three entries: breakdown, RDR, and retest. This is a retest of the short side, so you could see it made a big move down. It retested right here into the moving averages, into the previous kind of high and support level, and then it made a new low, and you're targeting this low, of course, as your main target, and then into the downside. How does this look like on the lower time frames? Well, we're going to look for a potential double bottom, double top. That's usually what I look for a top. So if a stock kind of starts to get extended here at the highs and makes a big move up into resistance, I'm looking for a double top. So right here, you can see one top, two top. This is going to be your short. You can kind of put a stop over the highs right here, and then you can look to target these lows, right? So that would be also a very, very good risk to reward. So guys, this is how you short in the market. You always want to make sure you find good setups. This is the most important thing, because at the end of the day, if you don't have good setups, you don't really have anything in this market. It's still very selective. Just because the trend is down doesn't mean you're going to make a ton of money playing anything to the downside. Make sure you have good setups. Make sure that you're not selling and shorting when things are so extended from the moving averages, because if you're selling something when it's too extended from the moving averages, you're going to get caught on the other side. The best time to short is when stocks are right next to the moving averages like this, because that's where the fuel is, right? Think about moving averages as fuel. Whenever they come back, that is when they kind of give you that fuel for the next leg down or the next leg up, depending on what trend you're in. So hopefully this helped you guys understand how to short the market. I took some great trades on the tickers Costco and IREN. If you're still a little bit confused, definitely make sure to download my checklist down below. It'll go exactly over the stuff that I like to look for on the long side and the short side, and this will help you guys out a ton with your trades. Hopefully you guys enjoy this video, and I'll see you all in the next one.